Very good morning to all attending this webinar today. My name is Sudarshan. I work at ArthaYantra in research, and I will be taking you through today's webinar. We will look at the month of November and a bit of December to see how the markets have performed. Now, the month of November has been quite a landmark month, so to speak. There have been lots of economical and geopolitical changes that have happened in the month of November, and a lot of it is currently affecting the markets. I think the most biggest event that affected our economy that happened in November is the demonetization of the 1,000 and 500 rupee notes. That's something that is affecting us today as well. Besides that, there was the election of Donald Trump as the 45th president of the United States, and that has sent a lot of the global markets into a dizzy. It strengthened the dollar while all other currencies fell. One other event that took place in November that is somewhat overlooked at the moment is the GST bill was passed. The taxes rates for the GST was passed. It is currently a 4-slab system, and we will be talking about that a bit more today. So the topics we will be covering is a global macroeconomy, and we look at how some of these affect the Indian economy, the GST bill, the GST tax slab which was passed, and a quick look at how some of these events will be affecting your finances. And finally, we will arrive at the investment strategy. Now, let's begin with looking at the world's largest economy, the United States. In November, the United States performed quite well. Jobs were added, unemployment rate came down, hourly wages have gone up year on year. Essentially, you look at all the details, it seems that the US economy is doing quite well. In fact, the US GDP for the previous quarter, which was initially projected at 2.9%, was revised upwards to 3.2%. And it seems that this trend is continuing. If you look at the service activity, the manufacturing activity, compared to last month, they are either holding or they have become better. So if you look at because of the hourly wage growth and US being big consumers and spenders, new orders for the services, new orders for new processed goods have picked up in the United States, and this in turn is driving their economic growth. In fact, consumer spending has been found to be up by 2.8%. Now, if you look at another economy that is right across their ocean, Japan, their economy seems to be doing well as well. They had an expansion in all their sectors, and for example, manufacturing, which was like consecutively declining for quite a few months, has seen 3 months of successive growth. That's something for Japan to actually be cheering about, because, well, Japan exports goods to boost its economy more than consume. So with the manufacturing activity picking up, it seems quite good for Japan as well. But if you might know, from the 1990s, Japan has had a sort of a financial crisis. They haven't they haven't been able to grow as fast, and they are facing chronic deflation. So if you look at the wholesale price index for Japan for the previous month, it's fallen down by 2.2%, signaling that there is once again there is a deflation. But if you look at the producer price index, which is basically the costs that a servicer or a manufacturer takes in, that has gone up by about 0.4%. But this is mainly because the world commodity markets are becoming costlier. But if you look at some of the other factors, Like unemployment rate, for example, that's uh, that's a 3%, and this is multi-decade lows. Unemployment rate has not been this low in Japan since 1994. So there are a lot of aspects in Japan that are showing positives. Now, um, what exactly driving this growth at the moment is that both the United States and Japan have very low interest rates issued by the central bank. The Federal Reserve until recently had the interest rate at 0.5%, which is very low compared to what India is right now. And Japan, on the other hand, went a step further. They charged 0% and even charged a negative interest rate for a while. But it seems that this low interest rate is creating enough cash for the people to spend, creating enough investments, and it seems at the moment that this seems to be, helping the USA and the Japanese economy grow. Another developed economy, which is working on low interest rates at now, is the European Union. Now, if you look at the EU's numbers as well, they seem to be indicating quite a bit of improvement. And after the debt crisis of 2008, unemployment went to double digits, and unemployment is now, for the first time in almost 8 years, below the double digit in percentage mark. And this is something good for the European Union. But as I had said before, this is primarily because of a low interest fueled growth. But it is growth nonetheless, and I'm sure that they will be happy to see numbers of manufacturing picking up, services picking up, and overall economic activity picking up as such. Now, because of this improved picking up of activity, there's an increased demand, and with the increased demand, we can see the inflation is going up. And inflation is a problem for the European Union as well. They too are looking at a target of 2% annually, and the 0.6% is something that they are celebrating at the moment. Now, if you look at the improved demand, now this is creating a sort of there's a lot of pile up of demand that are happening at the manufacturers and at the services. Now, manufacturing has its capacity constraints, and with more and more demand coming in, we see that there is a lot of jobs being created in the manufacturing sector, meaning unemployment rate is going to go down further. Consumer confidence is also picking up, so we can expect more and more demands to be coming in. So it seems that there is quite a bit of positives coming in the European Union way. But going forward, we might see a bit of turbulence. Recently, Italy, which was one of the 5 countries which were potentially facing debt crisis, along with Portugal, Ireland, Greece, and Spain. Recently, the former Prime Minister of Italy, Mr. Matteo Renzi, he came up with a series of reforms constitutionally to rein in the debt. Unfortunately, none of the measures were accepted, and he had to resign as the Prime Minister. Now, what this means for the European Union is there potentially might be cracks in its United States, in its member states as such. So the upcoming elections that are happening in France, in Germany, and in Netherlands will be quite critical for the future of the European Union. Now, why we look at developed economies first is primarily because the world economy is something like we have the developed economies who are primarily consumer driven, and then we have the emerging economies who do the manufacturing of goods to sell to the developed economies. And The best example for that in recent years is the Asia Pacific, specifically led by China. Now, China, as you know, is sort of like the factory of the world. They manufacture a lot, and they sell primarily to the developed economies, and that's how they have been growing. Now, over the past few years, fueled by the uh, subprime mortgage crisis in the United States and the Greek debt crisis uh, in the European Union, the world economy did slow down. And because of the slowing down, the world economy, a big reflection of it was seen even in China. So, uh, so the Chinese who had seen growth of about double-digit percentage growth in the GDP through most of the early 2000s are now looking at no are managing to get a 6.5 to 7% growth in the GDP. Now, because of this decreased economic activity, inflation also goes down in China. But since earlier this year, China has slightly shifted more towards a consumer-driven economy rather than a manufacturing-driven economy. And which is why we see that the inflation in China has gone up slightly by about 2.3%. Services, which primarily drives most of the developed economies and India, has gone up in China as well. Manufacturing activity, which was about it was weakening for quite a while, is now slowly picking up. New orders are growing, but it's not growing at a very fast rate. So we'll have to see how much China can sustain its growth in this particular way. Now, the world economy as such is, slowly picking up, but the demand for goods is still to pick up robustly. Now, China has a lot of capacity to manufacture to the world, and the Southeast Asian countries, like Vietnam, Thailand, and Philippines. Now, these countries are also into the manufacturing, pretty much like what China is, but they don't really have the cost advantage compared to China, which is why we see that the Asian manufacturing activity drop. Raw material prices are rising for globally. We will be discussing that a bit more in detail. Now, with the rising raw material costs and their already low demand, the Southeast Asian manufacturing countries are looking at are going through a lot of trouble. So, the previous quarter, for example, Singapore, which is the developed economy of the region, actually had contracted, as in the GDP for the previous quarter was negative. Now we see this to be a problem that might spread to the rest of the Southeast Asian economies, and we might potentially be looking at a slowdown from that region as well. Now, speaking of commodity prices rising, the biggest exporters of commodities are either African countries or Latin American economies. Now, Brazil, which is the biggest economy in Latin America, continues to be in a recession. Now, this is affecting its other neighbors. Argentina, like for example, is the biggest trade partner of Argentina is Brazil, and with Brazil being in recession, Argentina is also suffering. Now, the most robust economy of the region at the moment is Chile. Now, even Chile is looking at a slowdown in economic activity. Now, the economic activity, which is sort of like a proxy for the GDP in Latin America, it fell by about 0.4% in October. Now, Chile primarily exports copper, and copper prices are actually picking up. In fact, in November, copper prices had gone up by almost 20%. Now, if that's the case, we could see that the Chilean economy will pick up in November and eventually in December as well. So, which is why the GDP of Chile will grow by about 1.5 to 2%. Whereas the situation is not that great for some of the other Latin American countries. consider Mexico, for example. Mexico is now in big trouble because of President-elect Donald Trump in the United States. Now, Mexico primarily is a manufacturing hub. It's sort of like a substitute for what China is to the United States. Manufacturing takes place in Mexico, and these goods are exported to the USA. Now, Donald Trump has made statements like that are almost virtually blockading of Mexico. Now, if that happens, Mexico will not have a trade partner that big to fill the gap of the United States. In which case, Mexico will also go into recession. But fortunately, it managed the manufacturing activity in Mexico managed to pick up in the previous month. Now, if you look at commodities in a bit more of detail, this once again is an event that happened in November that is going to potentially affect us. OPEC, which is the Organization of Petroleum Exporting Countries, these are basically the Middle Eastern countries, Saudi Arabia, Iran, Kuwait, and so on, and a couple of Latin American countries. Now, these countries export almost 70% of the oil to the world. And until now, because of geopolitical tensions, Iran and Saudi Arabia are typically rivals, and they are also part of OPEC. Now, because of this rivalry, Iran and Saudi Arabia did not arrive at a sort of consensus to cut down oil production. So, oil was available in surplus in the market. So, oil prices fell to as low as $20 a barrel because of these two's rivalry. That was kind of a benefit for India. But the very low oil prices affected the OPEC member countries quite badly. Like for example, if you have followed a bit of the news in Saudi Arabia, you would have known that Saudi Arabia did not levy taxes on their people because of the excess oil revenue which they made. Now, with the very low oil prices, their treasury was affected. So they slowly began introducing taxes. They removed some subsidies from their own fuel prices, and so on. And a similar case was there or happened in Iran as well. Now these factors helped Saudi Arabia and Iran come to a deal to cut down oil production. Now this deal was reached on September, and it was once again ratified in November. Now, because of that ratification, you can see, like in the graph to your left side, how on November 29th itself, the oil prices spiked from under 40 for nearly $45 a barrel to almost $49 a barrel, and it continued to grow the next day as well. In fact, it is continuing to grow now also, because OPEC also tried to cut down. To reach a deal with oil production to be cut down with some of the non-member countries as well. Most recently, they had spoken with Russia, and they have sort of reached a deal to cut down oil production as a whole. Now, if this happens, oil prices will continue to rise a bit more to about $56 to $58 a barrel. And because of this alliance between Russia and OPEC, whatever surplus oil we have right now could be in the world economy, it'll get reduced by half. Now, commodities have risen otherwise as well, but not so for gold. Gold prices have been dropping for the last 3 months. Now, the reason for this primarily is this. Gold is traded primarily in dollars. Now, if you have followed our webinar and if you follow the news for the last 3 months, you will have seen that the US economy is actually growing. As we had discussed before, the previous quarter, the US GDP had expanded by about 3.2%, which means people will buy dollars a lot more because the US is seen as a safe haven for investment. Now, with more and more investment in the United States, the value of dollar will go up. And if the dollar value goes up, the amount of gold that you get from for a dollar will go down. Will go up. I'm sorry. Now, because of that, the gold prices as such will go down. So, with now the U.S. bond yields, as I said, is considered to be a safe haven for investment. The yields have increased, and with an increased yield, essentially people will be investing in the US bonds more, and gold prices will continue to fall for a while. But it depends on the incoming presidency as well. Like for example, Barack Obama's policies, which did not work, which did not show robust numbers for quite a while, have been showing quite a bit of improvement over the last year. Now, if the policies are continued, or if these policies are not disrupted, then we might expect to see the US economy continue to grow. And President Trump has at the moment promised to invest in infrastructure. And typically, when countries invest in infrastructure a lot, it means that their economy is going to grow. So there's a lot of hope in Donald Trump, and if he does not deliver as promised, the numbers will go down, and that's when we will see gold prices go up. So until Donald Trump assumes presidency, gold prices will continue to fall. Now, as I had said, as Trump had discussed investing in infrastructure, the raw materials which are used for infrastructure primarily is copper. Now, copper price went up because Trump said he's going to invest in infrastructure. Now, with copper prices going up, we will see the Latin American economies like Chile, which we had discussed before. It will see an improvement in their economic activity. Now, China is slowly picking up its manufacturing, and China is the biggest buyer of copper in the world. And if their manufacturing activity picks up, copper will also rally. Now, we arrive at some of the events that happened in India in the past month. The GDP numbers were released, and the GDP for the previous quarter, which ended in September, was at 7.3%. And so India is still the fastest growing economy. Now, for the year, initially the GDP was projected to grow by about 7.6, about 7.8% by various rating agencies and various forecasters. Now, after the demonetization, which took place last month, there's been a severe drop in service activity. So, if you look to your right side, you will see the services, which was about 54.5 in the previous month. This month, it's actually dropped to about 46.7. Now, any reading that is below 50 means that the activity is dropping. So if it is closer to 50, it means that there is a drop in activity, but it's not very drastic. But if you look, for example, if you look at a composite PMI, it's 49.1. So overall, there is a slowdown in the economy. But if you look at the services, it's at 46.7, which means it's quite a massive drop. And this happened because of the demonetization. So despite the demonetization, manufacturing actually did pick up. And the manufacturers are quite optimistic. Business sentiment among manufacturing community is actually somewhat good. Although the auto sales for the previous month were mixed, there is still a lot of positives that the manufacturing community is looking at. Now, even though manufacturing activity picked up last month, it wasn't enough to compensate for the service loss. So the overall economic activity in our country actually did fall in the previous month. So we expect that the slowdown will continue in this month as well. So India may not, uh, the Indian GDP may not grow by that much in this quarter. But slowly, as more and more digital transactions happen, and slowly with the demonetization problem easing out, we will resume. I mean, the Indian economy will resume growing at a very strong, at a robust rate. Now, considering what happened in October and in a bit of November, we saw that the Indian economy is growing well. The inflation, which was the primary concern of the RBI, when the inflation was at about 5 nearly close to about 5% in October, the RBI decided it was comfortable enough to reduce the interest rates. In November, when they had, in December 7th, when they had a policy review again, the inflation reading for the previous month was about 3.63%. Essentially, it is comfortably below the RBI's target of about 4%. So there was a lot of expectation that the RBI would cut down interest rates. But unfortunately, or fortunately, it did not happen. The RBI decided not to cut down interest rates. There's a bit of a upside to RBI not cutting the interest rate. So recently, the Federal Reserve had raised the interest rates on December 9th. So if the Federal Reserve raises interest rates, the value of the dollar goes up. All other currencies weaken. And with the RBI not cutting down interest rates, the rupee was a bit protected, because if the RBI did cut down interest rates, we would have seen the rupee weaken, because there'll be excess rupee available in the market. The rupee value would have weakened against the dollar, and with the Federal Reserve also raising interest rates, rupee value would have weakened further. So in one sense, it is good that the RBI did not cut down interest rates. Now, it was a sort of a surprising move that the RBI did not cut down interest rates at that moment, because there is a cash crunch, there is a liquidity problem in the country at the moment. So at this point, it would make sense for the central bank to loosen its strings, which surprisingly did not happen. And the board of RBI considered that cutting down the interest rate at the moment will have a very minimal impact on the actual liquidity problem. So, this decision of the RBI has received a lot of mixed reviews. Now, one big event that happened in November was the introduction of the GST tax slabs. There was no consensus, so to speak, on what the single GST tax rate should be. So they arrived at a 4-level table. The taxes will be either 5%, 12%, 18%, or 28%. Now the hope is that this tax slab will eventually get to about it'll reduce from about 4 levels to only just 2 levels. Why? Because with more and more layers in your tax slabs, the complexity of it increases. And the whole point of the GST is to make taxation a lot more simpler. So there is an expectation that the tax slabs of the GST will finally be narrowed down to just 2 numbers. Now, if you look at some of the tax slabs for various goods and services across the country, that the GST was the GST tax slabs were considered to make sure that there is a good revenue increase, and at the same time the inflation is not increased. So essentials used by the common man, like bread, milk, vegetables, cereal, and salt are exempted from the GST. They will not be charged anything. And some of the other mass consumption items, like spices, tea, mustard oil, and some of the other cooking items, they will attract a fee of about a tax rate of about 5%, and this will actually bring down the cost of tea, spices, and mustard oil, which currently attract a slightly higher tax rate at the moment. Processed foods will attract about 12% of about 12% tax under the GST slab. Now, processed foods will also be relatively cheaper under the GST. Now, some of the other hygiene goods that we use at home, like soap, toothpaste, and oil, currently they attract a tax of about 27% cumulatively. Now they will be put under the 18% tax slab. So toothpaste will become cheaper, oil will become cheaper, soap will become cheaper, and also included in this category are smartphones. So smartphones will become even cheaper than what they are right now. White goods are goods like the air conditioner and TV, basically higher in electronics, and cars will attract about 28% in their GDP. Now, even within the cars, there are about two categories. There are the luxury cars, and then there are the common cars. Like, for example, a mini sedan is a common car. It won't come under luxury car category. Now, cars will attract about 28%, whereas a luxury car will attract the same 28%, but there will be an extra cess levied on it. Now, the whole point of this extra cess being levied is because under this GST, some of the states will be losing out revenue. Now, in order to compensate for the revenue, a cess has to be levied on some of these products. These products include tobacco, energy drinks, and the luxury cars. Now, this cess should ideally attract at least 50,000 crores of revenue for the government, because in the first year of implementing GST, about 50,000 crores is the loss to some of the state governments. Now, fuel was interestingly left out of the GST slab. Excuse me. Because fuel will continue to charge an excise duty. This excise duty is presently the reason why the fuel rates are somewhat stable at the moment, despite a drop in the oil prices in the previous few months. So, looking at all of this, we will have to consider the macroeconomic factors and the Indian factors to see how our personal finances get affected. So, if you look at the OPEC deal recently, oil will become costlier in the global markets, and India imports about 80% of its oil requirements. Now, with oil prices going up and the US Federal Reserve, raising interest rates, the rupee will weaken, and so the amount of oil that the $1 is going to buy will also be reduced. Meaning, India will have to pay more for getting the same amount of oil. So, fuel prices will go up, and if fuel prices go up, the food prices also go up, because transportation requires fuel, and with increased fuel prices, you will have an increase, and this will be passed on to the consumers. So, some of the food prices will go up, like vegetables, for example. Now, also we import quite a bit of commodities, and China, which is the world's largest importer of commodities as such, is doing well. It's trying to focus more on service economy. So this is boosting its manufacturing. Now with manufacturing in China going up, commodity prices in the world go up. And if commodity prices in the world go up, India has to import the same amount of commodities for a much higher price. So India's trade balance will go down. If India's trade balance goes down, the rupee will weaken. Essentially, any good which you import will become costlier. So any imported good which you buy will be a bit more costlier for you to buy. Gold prices are falling internationally, and gold will become. Gold jewelry will become much cheaper over time. Now, looking at the Indian factors alone, we had the demonetization, in which case in the previous webinar itself, if you joined us, we had explained that this move of demonetization will make some of the cash-based transactions like real estate will become cheaper. Now, besides that, if you look at GST, home consumables like soaps, shaving kits, toothpaste will become cheaper. Smartphones and some of the household appliances will become cheaper. But if you are going to go eat out, it is going to become a bit more costlier. Now, looking at all of these factors, we will now arrive at our investment strategy. Equity, since over the last 1.5 months, has weakened. This was primarily because of the Trump presidency as well as the demonetization. So even though the markets fell through most of November, there has been a sort of a modest rally. The bottoming out it seems to have happened. Now, India's macroeconomic factors are still intact, and we still have the largest population of young individuals, and we are still consumer and consumption driven. And with some of the goods and prices becoming cheaper, we can expect to see some of this being reflected in the stock markets as well. However, there will be a bit of volatility because of macro global factors. So over the long run, we will see the equity markets rally. So if you were to invest in an equity, timing the markets now will not at all be a good idea. What you could look at possibly is a systematic investment, so that irrespective of the volatility, you are making steady investments and your portfolio is also stabilized. Gold has been weakening since 10th November, and there are a couple of factors which might push the gold up, especially in the European Union, where we have key elections in Germany, France, and Netherlands. Now, these elections are critical to determine the future of the EU. If these elections favor the right-wingers and the separatists, we will see a potential collapse of the European Union, which in turn means a spike in the gold prices. And if you look at bonds, well, bond yields have been falling for quite a while. Now, this primarily is due to the very high demand for the Indian bonds assets because of the India's economic growth, and the government continues to invest in infrastructure and some developmental projects. So there will continue to be a very high demand for bonds, and with the increased demand for bonds, we will also see an increased a much more growth in the bonds assets. Now, with this, I think we arrive at the end of our webinar. Thank you very much for your participation. And we are now open to questions. So we have a question from Mr. Srikanth Kurma. Um, so I have a question on GST. Is the tax mentioned in table going to be common for all states set by the central government? Yes, the tax set by the central government will be held by all taxes. So the GST is meant for a uniform taxation of all the uh, a uniform taxation across the country, so that there's a smooth movement of goods and services across states without double taxation. So yes, there will be the GST slab mentioned in the table will be held uniform across the states. However, there is uh, there is uh, a slight modification in the tables that might be coming in the works. But despite the modification, we will see that the table will be uniform for all the states in set by in on the states across India. So we have another question saying, can we hold for some time for buying flats? As real estate going to be cheaper, any specific duration? Um, so it depends on what the purpose is that you have for buying a flat. For example, if you want to buy a home, you could probably be I, the prices of the homes will continue to fall. So you should not really be bothered about that as an investment. But if you are looking at it as purely as a source of income for investment, then we expect that the real estate will continue to fall for another about 2 to 3 for another few quarters coming up ahead. So in which case we would not recommend that you buy a home now for an investment as such. Do we have any more questions? So we have a question asking, should we buy gold for investment? If you have invested in ArthaYantra portfolio, you have already bought gold. Specifically because we recommend gold as a hedge for your portfolios as such. Because whatever volatility happens in the market, gold is a counterweight for your equity investment. So it is essentially a hedge. So having gold in your portfolio is good anytime. Even if gold is falling, uh, it is good to have gold as a counterweight in the portfolio, because uh, uh, over here we believe that it is not really sensible to time the market. So if equity markets fall suddenly, all of a sudden, you will see that gold prices will also rise suddenly. So in which case you are protected from losses. So keeping gold as an investment as part of your portfolio makes sense. We would recommend that you buy paper gold instead of no physical gold. Do we have any more questions? So if you do have any more questions, uh, please feel free to share them with us. Please send your questions, if you do, to research@arthayantra.com. We would be very happy to help you out. Now, thank you very much for your participation. Here's wishing you a Merry Christmas and a Happy New Year. Thank you.